Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 194 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, our Director of Research and Trading, Nick Whitaker, filling in for Matt since he is out of town. So welcome back, Nick. It's been so long that you forgot to put the mic in front of your face.
It's good to be here.
Yeah, good.
I looked at you. I'm like, something's wrong here.
So spring is in the air, Nick. We're at the end of Q1 of 2023. Obviously, just one more day in tomorrow since there's 31 days in March. Opening day for the MLB. Baseball's back. So hopefully warmer weather and sunnier weather is just around the corner.
It feels like it. Spring's in the air. So.
Yeah. From where you moved from, it's probably already a little warmer there than it is here.
I'm sure.
But the opposite for me. So being from upstate New York, I was talking to my parents yesterday, and it got up to 50 yesterday in Rochester. But then by like 6 o'clock at night, it was snowing. So definitely don't miss that.
No.
So. But as always, Nick, before we begin, just want to take the first few minutes to recap the performance for the month and the year of the major indexes that we track. And these numbers are as of the market close on March 29th. And this data is from YCharts. S&P 500 index up 1.5% for the month and up 4.9% for the year. The Dow Jones Industrial Average up 0.2% for the month, down 1.3% for the year. NASDAQ Composite Index up 4.1% for the month and up 13.9% for the year. The iShares Russell 2000 ETF, ticker symbol IWM, down 6.8% for the month, but still up 0.6% for the year. Then the Vanguard All World X United States ETF is up 1.1% for the month and up 5.1% for the year. 3-month Treasury rate at 4.8%, the 2-year Treasury rate at 4.08%, and the 10-year Treasury at 3.57%. Moving on to big headlines, current events. Nick, really, I think the main thing is that this chop fest in the market just continues on. Mm-hmm. And what I mean by that is markets can, in my opinion, have 3 different directions. We can be in an uptrend, we can be in a downtrend, or we could just be moving sideways, right? Mm-hmm. And that's exactly what we've seen. And I'll have Jenna throw this graphic up on the YouTube video and in our show notes, but it's a chart of the S&P 500 going back to mid-2021. And as you can see, Nick, really since April, May of 2022, so almost a full year, the S&P 500 has just traded in this range between the 4,300 level and the 3,500 level. And to me, what that tells me is there's just a lot of indecision for investors right now. There's not enough people that are convinced one way or another to push this thing higher or lower. And again, this has just been trading in this range of about 20% higher and lower for about a year now. Which is, it's a frustrating market for a lot of people, I think, especially after we've had, the market come in 2022. I think people have been expecting the market to just have a V-shaped recovery, but a lot of the times it's not like that. And it takes some basing, some consolidation, some sideways movement before we move back higher again.
Some reallocations in the market. You see some sector allocations changing. Yeah, I'll steal one of your lines to add on there, which is that this type of trading, I would say, is normal when you look at the context of history over multi-year charts. Yeah. Right. So, I know we would love the V-shaped recovery. It's easier to stomach, like the COVID. The steep drop and it comes right back really quick. That's obviously preferable for investors looking at their retirement and their savings and everything. I would just add that like you remind listeners often, this is normal. This is just the type of market we're in right now.
Yeah, absolutely. Moving on to tweets, articles, and research from this week. First thing I had was a tweet from Money Visuals, which is a social media account run by our friend Ashby Daniels, who we've had on the podcast before. So Money Visuals tweeted this on March 23rd. He says, when investors say that stocks are risky, what they mean to say is that stocks are volatile, which is true. And again, I think that's a big differentiator, Nick, that people often get confused. And again, in my opinion, and I think this is the consensus in the industry, is that risk and volatility are two different things, right? Volatility is, how much something fluctuates and goes up and down, right? Risk is, in my opinion, the permanent loss of capital. So it's important to have those two different distinctions. But he says the market on average goes up 3 out of every 4 years. And the result of these 3 good years for every one that's bad has been an annualized return of about 10% per year. Everybody knows this, yet despite this consistent long-term return, people fear equities because of how they perform every 4th year. And I thought that this was fitting, it being opening day for the MLB, Nick. Translating this to another field, imagine thinking a baseball player who hits 750 who hits 750 as a bad hitter simply because he strikes out swinging at 3 balls in the dirt every 4th at-bat. So every 3 out of 4 at-bats, the batter gets a hit. That's unheard of in the MLB. I think it's a really good year if you're batting over 300, that you get a hit out of 3 out of every 10 at-bats.
That's a great year. Yeah.
Right? That's a crazy thought, isn't it? As it is with thinking of equities as risky. In the lifetime of investors age 65 today, equities are up 97 times, excluding dividends. Yet the reputation for stocks being risky persists. Could it be that the way we view stocks has much more to do with how we describe them as risky instead of what is actually accurate? Simply that they are volatile, but that volatility has been well worth it in the long run. If we want to make better decisions with our money, we may need to unwind how we talk about what we own. So again, I just thought that this was really good, and it just made me chuckle with it being opening day today. 3 out of 4, that's 75% of the time, markets are up, which is really good. But I think it's hard. And I get it, right? It's hard to look past what the current situation is right now. And what's the current situation? We just had the worst year in the market since the great financial crisis. Yeah. And everyone's anchored to that. And they forget what happened in, the recovery after COVID. And they forget what happened between 2016 and 2020, right? Yeah. That low volatile environment.
Yeah. Nice linear chart there.
Yeah, I know, which is great, which is just 2 steps forward, 1 step back type of environment. Yeah. Which I have no doubt that we're going to get back to that. It just might take some time. And I think this is kind of relates to another thing that we talk about on here a lot, is that I think people spend too much time preparing for the bad times, and they don't spend enough time preparing for the good times. Mm-hmm. And as Ashby points out, on average, about every 3 or 4 years, the market's up. So we need to prepare for the good times too.
Absolutely.
So
I really like the comment.
He's done some good stuff. If people don't follow him,
changing some of that jargon that we're all guilty of it in finance, of just tossing jargon around. But that's a great point, because we often, I myself have said that equities are a riskier
me too.
asset. I say that, but there are of course ranges of risk within equities, but a generalized statement, it's definitely better to say they're a more volatile asset.
Absolutely.
I like that.
Second thing I had was a blog post from Michael Batnick on March 27th in regards to the Fed. So he says, it's been a rough couple of weeks, in parentheses, months/years, for one of the most powerful entities in the entire world. And he's referring to the Federal Reserve. Yeah. First, they were too late to raise rates. Then they raised them too much, leading to some of the biggest blowups in the banking industry that this country has ever witnessed. You would think that the recent events would cause them to pause and reassess the damage, but no, they went ahead with another 25 basis points hike anyway. even though this market is telling them to stop and maybe even cut. So what Michael's referring to is that last week, the Fed still raised rates by 0.25%, okay? And before everything unfolded with Silicon Valley Bank and Signature Bank, with those banks, blowing up, people were withdrawing money out of there that they couldn't control the deposit, or the depositors withdrawing their money. Before all that happened, the forecast was for the Fed to hike rates by 0.5%, so double than what they actually ended up doing. And in my opinion, Nick, the Fed still had to raise rates by some amount to keep everyone, and again, what I think is to keep the markets calm, because I think the markets would have freaked out if they didn't hike rates at all. And if they didn't hike rates at all last week, me as an investor looking at that is like, okay, just like 3 weeks ago, the forecast was for you guys to hike rates by 0.5%. And now just in a span of under a month, you're not doing anything.
Right.
My first thought is, okay, there's something wrong with the system.
What's up with the fundamentals?
Right. And they know something that the rest of the public doesn't know, because you don't just go from a 0.5% raising to not doing anything unless there's a serious problem. So in my opinion, they had to do something. I think that honestly, from my point of view, they're probably done hiking at this point.
The market thinks so as well. I actually have some research on that too.
Yeah, so great. Well, I won't say anything more on it, but again, I think they had to do something, or else people would have start to become very concerned that there was something else beneath the surface that no one else could see that's going wrong.
I think you're 100% correct, and I think there was a lot of talk in Europe about the same situation where the ECB came out. And this is after, Credit Suisse is looking for more money and scrambling for funds. And, a couple days later, the ECB hiked by 50 basis points. So they did the same thing, and exactly for the reason that you're saying.
Yeah, a lot of it is optics, right?
Yep.
Last but not least, have a tweet from our friend Ryan Dietrich on March 28th. And he said this: here are the previous 36 times the S&P 500 did not close beneath the December lows during Q1. This usually means good things. This is about to happen in 2023. And again, we'll have Jenna throw this graphic up for everybody on the YouTube video and in the show notes, but it's a chart of every time that the S&P 500 stayed above its December lows in Q1. And this kind of goes back to the things that we usually talk about, Nick, on the podcast with clients and prospects in the end of the year and the beginning of the new year. The trifecta, as we refer to them as. So we have the Santa Claus rally, the January barometer, in the first 5 days of January. Those are the three main ones that we look at, just to get an idea of possibly how the next year could play out, right? And the fourth, less talked about indicator is the December low indicator. And all that is what we look for to indicate that we're going to have a strong rest of the year is, did the S&P 500 in Q1 close below its December lows? And in this instance, it has not. We still have 2 more trading days, which I've seen crazier things, so it wouldn't surprise me if we ended up closing below the December lows. But at this point, we're holding above it. And what Ryan's pointing out here is that the performance for the full year for the S&P 500 historically has been extremely strong when we stay above those December lows. And to give people an idea about that, I think there's around 36 different instances going all the way back to 1950 when S&P 500 closes above the December lows, doesn't undercut the lows made earlier in the year. Average return has been just above 18.5% on average. And there's only been 2 times where the full year performance for the S&P 500 has been negative. That was 2011 and 2015. Market was flat in 2011, and in 2015, it was down less than 1%. So using, again, history as our guide, like we do, looking at these instances, Nick, 94% of the time when this happens, the market's positive by the year and usually well into the green.
Mm-hmm. And that's going through multiple decades and multiple major events through decades. I think you've sent around a chart recently about looking at all the different major events that happened over the past. I think that chart went back to the 1940s, but the 70s are in here. High inflation. You've got the mid 2000s. You've got
Clinton impeachment.
Clinton impeachment. Yeah, I mean, wars. There's all kinds of major events. So I know that Silicon Valley was a major event and felt like that, but major events can happen and the markets can still take off.
Right. So. Still taken in stride. So again, just taking a step back, looking at the data, we've talked about usually how strong these pre-election years are, the third year of the 4-year presidential cycle. This just adds to that. So on top of people being extremely bearish, sentiment is really low. Could surprise some people if we see some strength over the next, 6 to 8 months.
You could. I hope so.
Yeah, same. So I'll toss it over to you.
Yeah, so I'm going to start with just a recap of recent volatility in the equity markets. And I know we've covered this a little bit in previous podcasts, but I was reading an article last night and I saw a great chart, and I wanted to throw this chart up for listeners because I think it does a good job of illustrating why are we having such chop in the markets right now, and how quickly things can change from even a day-to-day basis. And we talk about the Fed and the Fed rate hikes a lot. Why do we talk about it so much over this year? And it's because these things are changing so constantly, because the narrative is changing a little bit. So this chart, it's kind of a tricky chart. Jenna will throw it up, but it shows the 2-week turmoil, so to speak, from March 6th to March 16th. And that was kind of right before Silicon Valley Bank and all that news, and then kind of once we got to the resolution with First Republic, right? And so the chart is showing the implied number of 25 basis point hikes expected from present to each of the next 8 FOMC meetings. So it's not showing the curve like we're used to seeing. It's showing, hey, at the next meeting we expect a 25 bip hike. At the next meeting we expect, et cetera, and it's adding from there. So in this first little mini chart up in the top left, you can see in July, the market was almost expecting 4 25 basis hikes from that period. And you can see day over day how this narrative changed and how drastically it changed. And so while this chart is up, I'm just going to quickly run through the highlights. On March 6th, it was a normal day. The S&P was up 1%. We're kind of a wait-and-see approach. Chair Powell was about to go before Congress. On the 7th, he went before Congress, Fed Chair Powell, and he was pretty hawkish in the market. It's like, oh, okay. Well, you see the expectations pop up a little bit.
Meaning that he thinks that we have to have higher rates for longer.
Precisely, yeah.
Tighter monetary policy.
There's some more of that financial jargon.
Yeah,
Sorry
exactly.
about that, folks.
Yep.
On the 8th, you get some news from Silvergate. Fed Chair Powell's on there again. On the 9th, SVB, Silicon Valley Bank, falls 60%. On the 13th, the Fed and the Treasury are prepping the lending program, and that was after the weekend, and you can see that's when things really start to change on the 13th. The 15th, then you have some news with Credit Suisse I mentioned about earlier. Swiss National Bank came in with $50-some million or $1 billion for them, and the 16th, the ECB raises rates, like I previously mentioned. And then you have more news breaking on that the banks borrowed a record amount during the discount window. And so you can see just how quickly the expectations for rate hikes have changed. And that leads me into my next piece here. Before I do that, do you have anything to add to that?
No, I don't. I just think, I think too many people take what the Fed says is biblical, and a lot of the things are out of their control. So you could have everything hunky-dory one day, and 2 weeks later, everything's changed. And that's what we experienced right here, right? So even though the Fed says, hey, I think this is our path, people just need to understand that anything can happen between then and their next Fed meeting, right? That could force them to change path. And I kind of, in our industry, that's like us saying, hey, at the beginning of the year, this is what we think the market's going to do. But then we could get some information in February, for our example, and that changes our outlook or our view. So this stuff is just constantly changing and evolving, especially how quick information travels in today's day and age. Again, just goes back to what we've talked about a lot this year, is that it's just a different investment environment right now, and things are moving so quickly. And that's why I hate getting the question of, hey, what's XYZ stock going to do? What's the market going to do, over the next 6 months or even this year? And it's like, listen, your guess is as good as mine. If I had that information, I would gladly tell you.
I get that question a lot too. And,
so
I'll give an opinion, but
a new piece of information,
little asterisks.
Yeah, exactly. Another war could start. There could be another virus. Another bank could go under. It's like this stuff just pops up seemingly unannounced sometimes, right?
Absolutely. So I have two more research pieces, and they're all kind of tied together this week. So the next piece is it's a piece of research from Charlie. That's actually from yesterday, Charlie Bolello at Compound Advisors. And the tweet shows the market expectation for Fed funds rate as of now. That chart that we just showed previously, that was from an article on the 17th, so right in the middle of all this, so that data was a little stale. Charlie's tweet says the following: the market is currently saying that the Fed's 9th rate hike last week, that 25 bip we talked about earlier, to 4.75 to 5%, that range, will be the last hike of this cycle, with a pause for the next FOMC meeting in May and rate cuts starting in the summer. So what's interesting to me is, even though a couple weeks has gone by, that chart that we previously showed, it's held pretty true. There's been less fluctuations over the past 2 weeks than there were in that March 6th to March 13, March 16 range. So that's the new expectations for the market, and this has held pretty stable over the past week or so. And then my last piece is looking at market reversion. And this data is coming from YCharts, but we build our own pricing tables, and this is just a pricing table that I built in Excel, and you can put in numbers and study it and whatnot. But we'll throw this up for listeners. And what I wanted to do is it's a very simple analysis, just like, hey, let's look at some reversion in the market. And so what this chart that we're going to show you has is it has the indices, and it has all the major sectors. And this first column here is the prior year performance. So that's the performance of 2022. And then there are 3 periods. The first period is from the end of the year to March 5th. Why March 5th? Because March 6th is like right before all of this stuff starts to happen.
Right.
And then the second period is from March 5th to March 13th. Why March 13th? March 13th was when the market bottomed, based on all the Silicon Valley news. Now, some of the wrap-up of the headlines were occurring the following days, but the pricing action bottomed on the 13th. And then the last period is the 13th to yesterday. And so everyone can see these numbers, and I highlighted a few sectors that are of interest to me. So you see technology, consumer cyclicals, and communications were the worst performing sectors of the previous year. You see, prior to the Silicon Valley news, they were leading the market. During the Silicon Valley news, they held up pretty well. They did not lead the market lower. They did go lower, but they held up pretty well. And interestingly, after the Silicon Valley news, they held up, and they actually outperformed. So those are more risky sectors in the market, which is just very interesting to me to see. We have this big reversion trade from last year, some underperformance, probably some profit taking last year, I'm sure, from long-term positions. But the market has really come back and supported some of these sectors that were so beat up last year. And then you have this big shock and this big scare, this is it 2008 again? I mean, the headlines were pretty nasty. But then you fast forward 2 weeks and some of the risk sectors hold up and actually go back and outperform. Now, the one caveat I'm going to put here that we can't see in this chart, and that I know Mark and I are talking about behind the scenes, is the breadth in the market in these sectors is starting to kind of fall apart a little bit. So these sectors in the last 2 weeks are being held up from some of the big cap names, and we're starting to see some dispersion across other sectors. So that is a caveat. But big picture, generally speaking, this is healthy. Yeah. Because if the market was truly freaking out, in my opinion, you would see that reversion trade in the last 2 weeks. They're not worried about the reversion from the last week. They're repositioning their portfolio to be much more defensive, most likely. They're going to higher dividend names. They're going to utilities. They're going to healthcare. And we didn't necessarily see that. So any thoughts?
Yeah, no, this is great. Thanks for putting this together. I think it's very important to point out what you just did, that a lot of the aggressive sectors are holding up pretty well. The NASDAQ and the technology sector is leading the way this year, and that held true through the whole banking fiasco. And I think that it's definitely a change of character from last year, but that's also part of the transition from a bear market to a bull market, is we start to see the sector rotation, right? Yeah. Just like we saw at the top at the end of 2021, beginning of 2022, we saw more value-oriented sectors start to outperform and continue to outperform for 2022. In 2023, it's the opposite. We're seeing more money come into more of these risk-on sectors, which is really good for the market. That's what we want to see. The only caveat in here is obviously the banking industry and the financial sector were hit the most during this whole fiasco. And if we look back at history, Nick, it's very hard for the market in general to make significant advances without financials participating. And I'm not saying they have to outperform financials, because we saw the decade from 2010 to 2020 that technology and discretionary just obliterated the rest of the sectors in the S&P 500, and we had a really strong market. Financials weren't outperforming, but they were rising.
They weren't lagging like aggressively.
They weren't falling. So I think financials are kind of at an inflection point right now. Sitting right around the 2007, 2008 highs before everything collapsed in 07 and 08. So I think it's kind of a make or break level for financials. But what it leads me to believe is that if technology and communications and consumer cyclical are holding up, that would lead me to believe that this level should hold and financials should have some sort of rebound, right? Yeah. And I really want to see financials participate over the next couple of months if this truly is transitioning to a new bull market.
Unlikely to outperform.
In
our opinion. But yeah, I agree with you. The one point I'll add for listeners is when you look at that chart in financials, even in this last period here, they fell again down. Was that 8.2%? Yeah, 8.2% from the 13th to the 29th. It's going to take a little time for the market to digest everything in that space in the different industries within financials. There's still a lot to be resolved. The FDIC is going to, what's it called? A special assessment, I believe is what it's called. They're going to do a special assessment. How much is that going to impact big banks on their earnings? A special assessment, essentially, they have an insurance fund. They had to pay out the insurance fund to cover Silicon Valley Bank and Signature Bank. And they're like, hey, we need to fill this fund back up. We're going to do a special assessment, which is essentially a fee to a bunch of the banks, large cap banks.
Yeah, really good to point out.
When you have an unknown fee, you're not going to dive into that sector and say, let's buy it up. I mean, who knows how big the fee is, especially when it's going to be spread across the sector. You don't know where most of the fee is going to go to. So there's still a lot to work out with that sector, which is why you have, that price is still lingering. So just the background there, we'll see what happens. There's more news to come out for the market to digest before I think finance can really stabilize and maybe kind of return. So that's coming soon.
And again, they're going to be the first to report for earnings season coming up in a couple of weeks. So we're going to find out pretty quickly here.
Yeah, 2 weeks I think. Mid-April.
What's going on?
JP Morgan will normally kick it off. I think it's April 14th, but don't quote me on that.
Yeah, definitely going to be the most widely followed earnings season for financials in quite some time. So
absolutely.
Well, thanks for coming on, Nick, and filling in for Matt. Going to bring in Taylor Ledbetter, one of our wealth advisors here at Jessup Wealth Management, to talk about her financial planning topic of the week surrounding best investment accounts for kids. So this is actually pretty timely, Taylor, because my sister-in-law actually just reached out to me last week because she is having a baby girl that is due the beginning of May, and she was like, hey, we're discussing college savings accounts and opening accounts for our kids. What do you recommend in this space? So even though I got back to her and responded with my recommendations, I'm going to send her this segment of the podcast because you might have some other accounts to enlighten us all about.
Yeah, this will be a good one for her.
Yeah.
All right, so the first type of account I'm going to talk about is a custodial Roth IRA. So a parent can open and manage this account until the child turns 18 or 21 in some states. And what's nice about this is that the child and the parent can both contribute, but they both have to have earned income for the year.
Right, just like any other retirement account, right? You have to have earned income to contribute to a retirement account.
Exactly. So yeah, both can contribute as long as there's earned income and they don't exceed the annual contribution limit of $6,500. So I'm sure most people know that Roth IRAs do grow completely tax-free. And what's nice about this type of account is your child could potentially use some of that money for certain expenses. So normally there's a 10% early distribution penalty if Roth IRA funds are withdrawn before 59 and a half. But a couple exceptions could be withdrawing funds for a first-time home purchase, or if those funds are for qualified education expenses. But I do think a custodial Roth IRA would be best if used for retirement. I think the tax savings would be better if the kid would save that money for retirement opposed to a down payment on a house or college.
Right. And I think this would be useful. And again, not every parent is going to know if their child's going to go to college or not. But if you have a child that, they're in their middle school to high school years and it's looking more and more like that they don't have an interest in going to college, this might be a better option just to get a head start on retirement savings for them.
Yeah, exactly. And the next couple of accounts I'm going to talk about are going to be more geared toward the college savings. So the next type of account is going to be a 529. It's specifically used for college expenses. There's no contribution limits, and something I like about the 529s is that there can be multiple contributors. So parents, grandparents, aunts, uncles, and withdrawals are also tax-free as long as they're used for qualified education expenses. Depending on the state you live in, some 529 contributions may be tax deductible, or you could qualify for some type of tax credit. Just depends on the state.
Yep. And one thing I'll throw out there too, Taylor, is that although there aren't technically contribution limits to 529 plans, they can be considered as a gift. So for 2023, for example, the maximum amount that you can gift an individual without incurring the gift tax expense is $17,000 per year per individual. So I could gift $17,000 to Taylor, $17,000 to Jenna, $17,000 to Nick. So that limit is per person. So if you have a married couple, double that for the amount that you can put into a 529 plan without triggering that gift tax expense. So I just wanted to throw that out there for people.
Yeah, and to add on to that, even if you go over the 17,000, you'll have to note that on a gift tax return.
Right.
But there still wouldn't be any gift tax technically due.
It would just go against your lifetime exemption.
Yeah, exactly.
Yep.
So in my opinion, I think the 529 plan is the best college savings plan out there. There's just a lot of advantages. And the next type of account I'll talk about is another college plan, but I still think 529s are the best.
Yeah, I think they are too. And I think what's going or being talked about in Congress right now is there's legislation being discussed that potentially if a kid doesn't go to college, a certain amount of that can be rolled into a Roth IRA for the kid or whoever the beneficiary was. So it'll give people more flexibility and have people be at least more comfortable that, hey, if I save all this money in this college savings fund and my kid doesn't go to college, they're still going to get some sort of benefit out of it. So
yeah, and just to add on to that, for a 529, say you have one kid that doesn't decide to go to college, but you have another kid that does, you could name the other child as the beneficiary of your 529.
Yeah, correct. It's really easy to transfer it to siblings, to other family members, back to yourself if a parent wanted to go and get, higher level education like a master's or something. So very easy to do that.
Yeah, exactly. So the next college account I'm going to talk about is called the Coverdell Education Savings Account. We call it a CISA for short. So again, this is specifically for education expenses. Contributions grow completely tax-free. Withdrawals are tax-free if used for education. But one big difference is that the maximum contribution to a CISA is $2,000 per year per beneficiary, and that's not tax deductible.
Right.
I think another really big difference is that there are income phase-out limits. So if you're single and your modified adjusted gross income is between $95,000 and $110,000 per year, or you are married filing joint and your income is between $190,000 and $220,000 per year, you will have a reduced contribution limit.
Yeah, so there's a phase out.
Yeah, exactly.
Yeah, and I think unless you have like a really specific situation, the 529 account's just the path to go on. I don't know if you feel any differently about that, but it just makes sense.
I agree. I mean, I think it's kind of clear the 529 has better advantages than the Coverdell account. And, the Coverdell, there's no tax deduction as well.
Right.
So I just think the 529s are a lot better.
Yeah, for sure.
The last type of account I'm going to talk about, it's a uniform gift to minors account or uniform transfer to minor account. Now, these are custodial trust accounts, and the parent can open one up on behalf of their child and obviously manage them until the child reaches a certain age, an age of majority. So for the uniform gift to minor accounts, that age of majority is 18 in Ohio. And for the uniform transfer minor account, the age is 21. Now again, there's no contribution limits. They are subject to those gifting limits, but technically no contribution limit. And you can have more than one person contributing money to the account. What's nice about these is that there's a lot more flexibility because these accounts are not specifically for education. But on the flip side, there's also no tax advantage for these accounts.
Exactly.
So I love the flexibility of these accounts. It's comparable to having maybe an individual account.
Yeah.
Essentially.
Right, that the parent can control it until obviously the child reaches the age of majority, which is either 18 or 21. And that's kind of nice too, because some parents will be like, yeah, at 18, I think, my kids are going to be able to make these decisions for themselves and take over the account at 18. But some of them might be like, 3 more years might not be such a bad thing. So we're going to go with the UTMA or the UTMA, where the age is 21. So,
yeah, I mean, I would say if you're not sure if your kid's gonna go to college, this might be the best route to go down versus the 529 maybe.
Right, exactly. And it's nice because the parent still has control of the account to a certain extent. And this could just help the education process. So even though the parent's still controlling it and making the decisions, they can bring their child in and teach them about this stuff as the account is getting contributions and as it's invested in the market. So another really good option if people don't want a specific education savings account, right?
Exactly. I agree 100%.
So, well, sweet. Well, thanks for enlightening us on savings accounts for kids, Taylor. I think that'll be really helpful for a lot of people. And again, just remember a lot of these accounts, kid needs to have a social security number to be opened up in their name or listed as a beneficiary. So I know some people are really eager that the day a new child's born, they want to open up a 529 account or a bank account or something like that. But just make sure that they have their social security number, and then you'll be good to go from there. So thanks everybody for tuning into episode number 194 of the Independent Advisors Podcast. Hope you all have a wonderful rest of the week, and we will be back next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.